Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. A quick recap of what happened on the global market front. Stocks on the Wall Street closed Thursday's trading session higher, driven by inflows into tech stocks. The Dow gained more than 140 points, Nasdaq surged nearly 200 points, while the S&P 500 ended nearly a sixth of a percent higher. Investors are also keeping an eye out for the September CPI data that releases later today in the U.S. markets. Meanwhile, the Asian markets track gains on Wall Street. The Japanese Nikkei traded more than a percentage point higher in the latest trades. Hang Seng also is trading with gains of more than 0.5%. Back home, it's a lackluster trade unfolding on Dalal Street. Nifty is now over 100 points off the opening highs. From markets to commodities and shifting focus to the crude oil prices, then the prices are trading near two-week highs and are on track for their strongest weekly gain since early June. This is after fresh U.S. sanctions on major Russian producers stoked supply concerns. The two companies account for nearly half of Russia's oil exports and are vital to funding the Kremlin's budget. This is following the sanction reports indicated that the Chinese state oil firms have halted seaborne Russian oil purchases already, while the Indian refiners in the meanwhile plan sharp import cuts to comply with the measures as well. Joining us is the first guest on the show, Amit Jain, who's the co-founder at Ashika Global Family Office, now joins us to discuss more in detail about gold, silver and, of course, the overall asset classes. Thank you so much, Amit, for taking time out for us. First of all, about gold then, and it clearly has been a star performer for 2025, nearly 60% of gains, a string of all-time highs, so much so that apart from the gold enthusiasts, it has been ETFs, which has shown us very strong numbers, and then almost mainstream because mutual funds to family offices to institutions, even corporate treasuries were looking at gold. How would you look back at 2025 and talk to us about gold?
Thank you, Manisha, for having me on the show. Honestly, we have been bullish on the gold since 2020. If you see various media interaction in last 4 5 years, we have been consistently bullish on the gold since the price was around $1,400 an ounce, and today the price has already touched $4,200 an ounce, which is almost a 300% return in last 4 to 5 years. But now, after this spectacular rally of 300% return, we are a little cautious on the gold because we anticipated this move very well after COVID, that gold will be in hedge against the US treasuries and the central banks are going to buy. And actually, it happened that most of the gold rally is fueled by central banks buying in the last 2 to 3 years. But today, we believe that that rally majorly has played out and it's a time to be cautious. So we are taking a cautious call on gold, and we believe there will be more a price correction and a time correction in gold prices in next 1 to 2 year perspective. First, we may have a price correction, and then you will find gold will be trading in a range rather than creating a new high in next 2 to 3 years. That's what we believe in. So we are switching out of gold now after being invested for last 4 years.
All right, Amit. So as you say, you're switching out from gold. What is it that you see in sense of prices for the next 2 to 3 years? This is the time period that you anticipate gold prices to underperform various asset classes, and I will come to other asset classes also. But first, about gold, what kind of an underperformance are you looking for, and what is your price targets really?
So honestly, on gold, gold will range from say 1,10,000 to 1,50,000 in next two year 1 or 2 year cycle. It will not You will not see gold at 2 lakh or 3 lakhs very soon. The rally which we have seen in last 1 year is unprecedented. 60% return on gold is huge, right? So that rally is not going to get repeated. The pace of the rally is going to slow down first, and then of course stable. Then there will be a price correction and a time correction. So we believe the broader range would be from 1,10,000 or 1 lakh to 1,50,000 to 1,60,000 in INR.
Amit, so what would you suggest investors to and how much to hold in their portfolios really?
So honestly, after COVID, we had been allocating almost 20% into gold. Now we are reducing that weightage from 20% to 5%, and we are moving that money into Indian large caps because we believe Nifty at a trailing PE of 23 looks highly undervalued to us. And particularly even in Nifty, we find IT sector as a contra bet looks extremely undervalued to us. And we believe there's a great entry point if someone has a 3-year horizon. IT sector in India is giving a great opportunity at a great price. So someone should not miss that.
Just to get some sense on history, really, Amit, and you seem to have done a lot of research onto this one. Every year that we've seen the gold prices run up quite strongly, whether it has been about in 2011, 1980, before that, we've seen equities perform well after a couple of years later than that. What is it that you are projecting this time around, and where are you taking your history lessons from?
So I think the history teaches all of us. It's always rhymes. So from 1972 till 1980, the gold prices has surged from $32 an ounce to $750 an ounce. I even find it difficult to calculate how much percentage it had been in that decade. And after that, we had a 30-year of bear run in the gold globally, right? And then again, it happened in 2011 when it touched the peak, and then we had a correction till 2019. So this is the cycle of the gold. And of course, after that, the market take a rally. So we believe that the majority of the gold rally is done now, and history will rhyme itself, and we'll have a big rally in the Indian markets. At least on the Nifty stocks, we are extremely bullish on, particularly in IT sector and FMCG sector. We believe they are going to lead the next rally of the Nifty.
IT and FMCG. Why would you believe that, Amit? Because when you look at the rest of the world, there still are tariff concerns, even slowdown concerns. Rate cuts is something that we're talking about as well. Would you believe that India, in that sense, is more resilient, could do better than rest of the world? And where do you see this confidence coming from?
So honestly, when I compare Nasdaq is currently trading at a P of 33. Honestly, uh, that's a earning yield of less than 3%, right? On the contrary, you're finding US GSEC, which is giving you a return of 4%. So there's a big dichotomy between the bond market and equity market globally. And I think with time, you'll find an equilibrium between both the markets, right? So the riskiest market, which is equities, are giving you 3% return, less than 3% return. And the safest market, which is the US bond, is giving you 4% return. So there's a big dichotomy. And I think in next 1 or 2 months, at least by December, you'll find this will settle down in either direction. And most likely, the US market will fall down, and the US market will fall down, and there may be a great opportunity for Indian stock market to average out at that prices. However, Nifty compared to Nasdaq is highly undervalued at a 23 of trailing PE. So we believe it's a value buying investing, and if someone has a horizon of 3 years, it's a great opportunity to be in with the Indian market.
Amit, I understand it's mostly about wealth creation, and wherever that comes in is where the portfolios will start moving into. While this year has been about gold and silver and platinum and various other commodities as well, would you believe that the next 3 years as a horizon that you're putting out, when you look at wealth creation, as you're suggesting, would mostly come in from equities, and that perhaps is because of corporate earnings and India undervalued vis-a-vis various other global indexes in that sense? Markets also are talking about commodity super cycle that can just about continue side by side. How would you look at the overall market then?
Honestly, that commodity super cycle has played out big time. If you see a decade from 2010 to 2020, the commodity stock has given less than 1% CAGR. The commodity ETFs or commodity sector has given less than 1% CAGR. And after 2020, that has just zoomed. So that super cycle is already played out to a great extent, and it's a time to pause. The pause can be in two ways. Either there will be a major price correction, that doesn't look likely, but of course there will be a time correction when when you'll observe that the price is not going up in a perpetual upswing. I think it is mostly into trading range. So that cycle has played out mostly in our view, and of course that will be beneficial for the stock market because commodities always bring inflation, and high inflation is bad for the market. So if commodities are not playing out well, I'm sure equities will play out well in the medium to long term.
All right. Amit, one final question. And you already told us that IT and FMCG is where you have your eyes set on in the years to come, the next 3 years, that is. How are you looking at defensives, manufacturing, banking, all of those sectors do as well? And if you were to put it on a rank, 1, 2, 3, how would you put many of these sectors like?
Number one, IT.
Okay.
Number two, FMCG. And number three, I'll say PSUs. There are some PSUs which are at mouth-watering valuations. I think they should not be left at their current valuation. If we have a combination of all three, I'm sure investor can make a great money in next 3 years.
You mostly spoke about gold, Amit. Are you looking at underlying commodities such as metals, copper, etc.? Because we have seen good gains come in for this one as well. Silver has outperformed with nearly 80% gains in this year. Are you looking at other commodities also?
Honestly, not. But
Okay.
still, we have to bet. We'll bet on copper, but honestly, not.
All right. Amit, thank you so much for your time. Really appreciate you joining in and making sense of what asset class can perhaps perform well in the next coming 2 to 3 years there. But with that, we'll slip into a short break. On the other side, we will be joined by Jatin Singh, founder and chairman at SkyMet Weather Services. Stay tuned for that conversation.